Stock markets have turned volatile globally following the conflict in West Asia. Stock markets and bond markets have corrected sharply. Gold, the safe haven asset, is strong, and crude oil has shot through the roof. No one knows how long this war will last. Now, we don't know what will be the economic consequences of this conflict. What should investors do in this time of crisis? Welcome to Geojit Spotlight. Markets are worried about the uncertainty regarding the war and its consequences. From the Indian perspective, the big worry is inflation. Crude oil has shot up by more than 30% within a few days. If crude price remains high for an extended period of time, India's trade deficit will widen, rupee will depreciate further, causing inflation. Higher inflation may force the RBI to raise interest rates, and this might impact economic growth and corporate earnings. This is the worry. If the conflict ends in, say, 3 or 4 weeks, this fear need not materialize. But no one knows how long the war will last. So what should investors do? A big lesson from market experience is that geopolitical crises like wars will not last long. Even when they last long, they soon become irrelevant, like the Ukraine war. Markets bounce back, giving good returns to those who remained invested and continued to invest. This is the lesson from the last 4 decades of conflicts and geopolitical crisis. Let us take the recent history, the last 6 years. These are instances which are very fresh in our memory. Here I have included geopolitical issues like wars and also calamities like COVID and policy calamities like Trump Tariffs. So let me summarize. In 2020, we had the COVID pandemic. The market crashed, big crash. In 2022, Russia attacked Ukraine. Inflation spiked, the market crashed. In 2023, the Gaza war began. Again, the market crashed. Not big time, but there was sharp correction. In 2025, President Trump shocked the world with his reciprocal tariff. Again, the market crashed. This time the crash was very sharp. In 2025, we had the Pahalgam terror attack, followed by India-Pakistan war, the Operation Sindoor. This also saw market correction. So each time a crisis broke out, the market corrected sharply. But then what happened? Each time the market bounced back. Nifty was 7,511 in March 2020 after the COVID crash. Now in March 2026, after all these crises which I explained, Nifty is about 24,000, delivering decent returns to investors who remained invested and continued to invest systematically. In the long run, the market will track economic growth and corporate earnings. Geopolitical issues will be significant in the short run, but irrelevant in the long run. After 3 or 4 months, it will be forgotten, like the Ukraine war. So what is the lesson from experience? The lessons from experience are: 1, don't panic and get out of the market. It will be wrong policy. 2, if your risk appetite is high and if you are a long-term investor, use this crisis in the market to slowly accumulate high-quality blue chips, which are available now at fair valuations. 3, never stop systematic investment plans. This is perhaps the most important. This is the most important message that I want to convey. Continue with systematic investment plans. If possible, increase the amount. Remember that the big advantage of SIP is rupee-cost averaging. When the market falls, you get stocks cheaper. And for your mutual fund investments, for the same amount of investment, you get more units. And later, when the market rebounds, this always happens, investors benefit. The short-term volatility will lead to long-term appreciation. SIP investors gain by continuing their investment. The only condition is that you should have a minimum 3-year investment horizon. 1-year returns can be poor, can be even negative. Even 2-year returns can be poor. But if you have a 3-year time horizon, returns will be good. About 3 years, returns will be very impressive. Look at this data showing 3-year, 5-year, 10-year returns from SIPs from various schemes. Here I've taken returns from SIPs. Remember this? I've taken returns only from SIPs. SIPs from different categories of mutual fund schemes like large cap, mid cap, small cap, large and mid cap, value, flexi cap, aggressive hybrid, balance advantage fund, etc. Also, it is important to understand that the returns are average returns, not the best returns, not the worst returns. These are average returns. I'm not explaining this. The data is self-explanatory. Just look at the average SIP returns. The 3-year returns are good. The 5-year returns are very good. These are CAGR returns. The longer you continue with SIPs, the better. More important, there won't be any loss. This is the lesson from investment history. Investors can learn from history. Best wishes.